My name is Michael Granding. I'm a professor at Providence College, and this semester I'm teaching managerial accounting at the graduate level. This is MBA 603 at Providence College, which is essentially managerial accounting. Today's material is going to be standard costs and variance analysis. We've already covered Chapter 10 from the Garrison, Noreen, and Brewer book. But we're looking at the appendix now, because what we've previously learned how to calculate is we learned how to calculate the direct materials price and quantity variance. We've also learned how to calculate the direct labor rate and efficiency variances. And we've learned how to calculate the variable manufacturing overhead rate and efficiency variances. What we want to learn now, this is from the appendix 10A, is we want to learn how to calculate the fixed manufacturing overhead variances and what they mean. Now, these calculations are slightly different. The two variances that we're talking about are the fixed manufacturing overhead budget variance and the fixed manufacturing overhead volume variance, calculated slightly differently than the previous variances. But one of the very first things we have to do is recalculate or remind you how to calculate the predetermined overhead rates. Because as I've mentioned earlier, the standard price is the predetermined overhead rate. And what we want to do now is we want to break down the predetermined overhead rate into a variable predetermined overhead rate and a fixed predetermined overhead rate. And what is important to remember is the overhead rates are calculated from budgeted information, estimated information. Please remember, these budget numbers are prepared in advance. This is the planning budget planned in advance. And as you recall, the formula for calculating the predetermined overhead rate is the total estimated or total budgeted manufacturing overhead dollars divided by the total estimated or budgeted denominator value, the activity base. So this comes from the budgeted information. So what I'd like to do is use the example that is in the appendix. By the way, it's an excellent example. Walking through this example is actually better than the publisher's PowerPoint presentation. So I'm going to share my screen with you. We're going to pull up that analysis. And let me see, we go here. I'm going to share my screen. And I hope I'm sharing my screen with you. I believe I am. Yes, I think I am. Okay, so this is the appendix. For those of you, if for some reason this is not coming through, please refer to the appendix 10A, which is on page 472 of your textbook. And I'm literally going to just kind of walk through it. If you need to, go ahead and pause the video so you can grab your textbook, but I'm going to literally walk through these 3 or 4 pages to talk about the fixed manufacturing overhead variances. So in this appendix, we'll explain how the predetermined overhead rates that were discussed in the job order costing chapters can be used in a standard costing system. Throughout this appendix, we assume that an absorption costing system is used in which all manufacturing costs, both variable and fixed, are included in the product cost. That is the definition, by the way, of absorption costing. Here is the example I'd like to work with. Microdrive Corporation, a company that produces miniature electronic motors. The data within this exhibit is divided into 3 sections. The first section summarizes the budgeted overhead costs and budgeted machine hours included in the company's planning budget. Note that the company's planning budget is based on producing 25,000 motors. That's the estimated output. Given that 2 machine hours are allowed per motor, the planning budget allows for 50,000 machine hours. At this level of activity, the budgeted variable manufacturing overhead is 75,000 and the budgeted fixed manufacturing overhead is 300,000. There's a summary of the budgeted numbers. Total production, 25,000 motors, as we talked about. The standard machine hours per motor should take 2 hours per motor. So they had budgeted 50,000 machine hours. The actual output, okay? So please, you need to look for 3 things in this analysis. You need to look for budgeted information, you need to look for standard information, and you need to look for actual information. So the actual output was 20,000 motors. Please note, that's 5,000 motors less than budgeted. The standard machine hours, again, it should have taken 2 hours per motor. Therefore, they should have used 40,000 machine hours. That's the standard machine hours allowed. Here's the actual information. Actual variable manufacturing overhead, 71,400. Actual fixed manufacturing overhead, 308. And here's our actual machine hours. So you'll notice several things. The budgeted machine hours were 50,000. The standard allowed, what they should have used was 40,000 machine hours, and what they actually used was 42,000 machine hours. The second section includes information that Microdrive will use to apply overhead costs to production. Notice that the company actually produced 20,000 motors instead of 25,000 motors included in the planning budget. Given that 2 machine hours are allowed per motor, the standard machine hours allowed for the actual production is 40,000 machine hours. This is the quantity of machine hours that the company will use to apply variable and fixed overhead costs to production. The third section summarizes the company's actual variable and fixed manufacturing overhead costs for the period, as well as its actual machine hours used during the period. As we described in greater detail shortly, it is very important to understand that in a standard cost system, the actual hours is not used to apply cost to production. Variable and fixed overhead costs are applied to production using the standard hours allowed for the actual production. That essentially summarizes the information that is in this box here of given information. Budgeted, standard, and actual. Here's a reminder. Recall from earlier chapters that the following formula is used to establish the predetermined overhead rate at the beginning of the period. And we talked about this in my introduction. The predetermined overhead rate equals the estimated or budgeted total manufacturing overhead dollars divided by the estimated or budgeted total amount of allocation base, in this case, machine hours. The estimated total amount of allocation base in the formula for the predetermined overhead rate is called the denominator activity or the denominator value. It's on the bottom, right? Once the predetermined overhead rate has been established, it remains unchanged throughout the period, even if the actual level of activity differs from what was estimated. Consequently, the amount of overhead applied to each unit of production is the same regardless of when it is produced during the period. Microdrive Corporation uses 50,000 budgeted machine hours as its denominator activity in the predetermined overhead rate. Consequently, the company's predetermined overhead rate would be as follows. Okay, that's the combined. That is the total estimated manufacturing overhead, right? Budgeted 375,000 machine hours. Let's go back to that box where all the given information here is. It's the total budgeted, which includes what? Both variable and fixed. But we can break it down. In fact, we need to break it down between the variable and the fixed because we're calculating separate variances. Please always remember the standard price in variance analysis is the predetermined overhead rate when it comes to calculating overhead variances. The predetermined overhead rate can be broken down into its variable and fixed components. So please remember, the numerator, the top number for the variable is the budgeted variable overhead. And for the fixed, it's the budgeted fixed overhead. Also note, the denominator value still stays the same at 50,000 machine hours. So you can now see you have a PDOR, standard price, for variable manufacturing overhead of $1.50 and fixed at $6. The two of them should add up to $7.50. For every standard machine hour recorded, work in process is charged with $7.50 of manufacturing overhead, of which $1.50 represents variable and $6 represents fixed manufacturing overhead. In total, the Microdrive Corporation would apply $300,000 of overhead to work in process as shown below. $7.50 per machine hour times the standard hours allowed, right? The flexible budget, they actually produced, the actual output was 20,000 motors. The standard allowed, it should take 2 machine hours per unit, hence 40,000 machine hours. This is a comparison between the normal and the standard cost systems on how manufacturing overhead applied. These are 2 T accounts. Please note on the right-hand side, manufacturing overhead, the debits in that account, which you remember from Chapter 2, Standard Cost System, that the debits represent the actual costs and the credits represent applied. In essence, based upon the standard cost system, the credits represent the flexible budget. The net difference is either under-applied or over-applied. Let's take a look at the budget variance. So there are 2 variances that we're going to be looking at here. They're looking at the budget variance and we're looking at the volume variance. 2 fixed manufacturing overhead variances are computed in the standard costing system, the budget variance and the volume variance. These variances are computed in the following exhibit. The budget variance is simply the difference between the actual fixed manufacturing overhead and the budgeted fixed manufacturing overhead. Very simple. So here's the chart, and as I've mentioned, I prefer using the chart. The budget variance is simply the difference between the actual and the budgeted value. Let's look at this chart. The far left continues to be the actual cost. The far right is the standard or the flexible budget, which is the same as the other 3 variances. But what's important here is that the middle number is not what you remember it to be, AQ times SP. It is not. It is simply the budgeted number. So here you can see these numbers come from the chart that's given above. Let me just go back up there and take a look at it. You can see the budgeted fixed manufacturing overhead is $300,000. And you can see the actual fixed manufacturing overhead is $308,000. So you can see there's an $8,000 unfavorable variance. They spent more than budget. That's probably the easiest, the simplest variance to calculate, the fixed manufacturing overhead budget variance. But what about the volume variance? Well, the volume variance is simply the difference between the budget and the flexible budget. Let's look at the flexible budget again. The flexible budget, remember, tells us what it should have cost at the actual level of output. The actual level of output was 20,000 motors. It should have taken 2 hours per motor. Therefore, they should have used 40,000 machine hours multiplied times the standard price. And when it comes to overhead, the standard price is the predetermined overhead rate. The predetermined overhead rate for fixed manufacturing overhead is $6 per machine hour, as we calculated above. So they should have spent $240,000 on fixed overhead for those 20,000 motors. But the budget was $300,000. They spent $60,000 more on the budget. It's a volume variance, though. So think about it. It's an unfavorable volume variance. Volume relates to what? Relates to activity. So let's think about this for a minute. Let's go back to the beginning. They had budgeted 25,000 motors. They planned on producing 25,000 motors. They actually produced only 20,000 motors. That's a 20% decrease. They came in 20% below budget, right? 25,000 minus 20,000 is 5,000. 5,000 divided by 25,000 is 20%. They were under budget by 20%. The volume was below budget by 20%. Look at the volume variance. The budget was $300,000. 20% of the $300,000 is what? It's $60,000. So the volume variance makes complete sense. They were below volume. They did not hit their volume for whatever reason. The budget variance is somewhat disturbing, but it's only $8,000. It's relatively insignificant. Let's read on. If the actual fixed overhead cost exceeds the budgeted fixed overhead variance, the budget variance is labeled unfavorable. If the actual fixed overhead cost is less, then it would be favorable. Let's talk about the volume variance. And the volume variance is simply the difference between the budgeted fixed overhead and the standard cost or the flexible budget. When the budgeted fixed manufacturing overhead exceeds the fixed manufacturing overhead applied to work in process, the volume variance is labeled unfavorable. When the budgeted fixed manufacturing overhead is less than the fixed manufacturing overhead applied to work in process, the volume variance is favorable. This is the equation method, producing the same answer. Let's look at this paragraph here. The volume variance is often viewed as a measure of the utilization of facilities. If the standard hours allowed for the actual output are greater than the denominator hours, it signals efficient or inefficient usage of facilities. However, other measures of utilization, such as the percentage of capacity utilized, are easier to compute and understand. Perhaps a better interpretation of the volume variance is that it is the error that occurs when the level of activity is incorrectly estimated and the costing system assumes fixed costs behave as if they are variable. This interpretation may be clearer in the next section that graphically analyzes fixed manufacturing overhead variances. Now, I don't really want to cover the graphic chart. You can take a look at it. The volume variance is some cautions about using the fixed overhead variance. The volume variance for fixed overhead arises because when applying the cost to work in process, we act as if the fixed costs are variable. The graph in 10A-4 illustrates this point. Notice from the graph that fixed overhead costs are applied to work in process at a rate of $6 per hour as if they are variable. Treating these costs as if they are variable is necessary for product costing purposes, but some real dangers lurk ahead. Managers can easily be misled into thinking that fixed costs are in fact variable. Please remember your definition of a fixed cost. The total cost stays the same regardless of activity. Here's another way to look at the total variance. Predetermined overhead rate on a combined base was $7.50. The standard machine hours, was 40,000 based on actual output of 20,000 motors at 2 hours per motor. Manufacturing overhead applied was 300,000. The actual combined variable and fixed was 379.4. It's underapplied by 79,400. So one way to look at it is the debit in manufacturing overhead was 379,400, representing the actual cost. The credit was $300,000. So they have net underapplied, right? They have a net debit. How do they clean that up? Well, remember, if their policy is to close the net debit or credit to the cost of goods sold, in order to clear it up, they're going to debit the cost of goods sold for $79,400 and credit manufacturing overhead for $79,400, bringing manufacturing overhead to zero, but increasing the cost of goods sold by $79,400. That's why it's unfavorable. It creates additional costs. There's a summary of your variances. And really, that's essentially what I wanted to cover. I don't actually think I've shared that. My apologies, but you really wanted to follow that along in your textbook. Thank you.